Good evening. Welcome to our global trade and political economy, Econ 330, Medgar Evers College, City University of New York. Today is March 19th, 2024, and welcome to today's lecture and afterwards office hour. In the past 3 weeks, we have completed a three-part study of the three theoretical perspectives of global trade. As a refresher, these include the liberal perspective, the realistic perspective, and historical materialism. This week, we will begin a three-part study of international trade relations and their components. And these include international monetary relations, which we will cover this week, or we are covering this week. Next week, we will cover global trade relations. And in 2 weeks, we will cover regional trade arrangements. International trade activities are driven by resource transfer, i.e. money, as you know. The whole point of selling goods and services is to derive or generate income. Therefore, one must understand the nature of international monetary system in order to appreciate global trade relations. In a three-week study that begins today, we will address how nations relate to each other in the process of trade. For example, a country can limit the exportation of certain goods, or trade could be encouraged freely by one country but limited by another. We will also address the following question: what are the reasons for tensions and conflicting differences in policies? One way of resolving conflicts will be to negotiate cooperation between nations and sometimes group of nations. This would, of course, be trade agreements or regional trade bodies, as we will study in the weeks ahead. Since the course is based on global trade and political economy, we will discuss the mechanics of money and trade. Beginning with the balance of payments, we will discuss how monetary flows affect the ability of a nation to transact international business with others. As one example, if a nation is unable to trade due to monetary limitations or imbalances that may be temporary, these may pose problems when they seek arrangements to help them address the temporary problems. This may lead to long-standing or lingering inability to participate in global trade. Consider this, for instance. If a country is unable to participate in global trade, then it is unable to earn foreign exchange and therefore unable to finance the purchase of goods and services in the international market. You can see how quickly the country will begin to grind to a halt. Therefore, addressing this challenge through bilateral arrangements rather than institutional support from the IMF may lead to a political control of one country by another, which in turn could create international political issues within and between nations. If I were to unpack that a little bit, I would say that in the next week or two, there is going to be a briefing by the World Bank at the Hudson Institute. And I believe the World Bank is going to discuss the inflexibility of Chinese government in renegotiating debt that is owed by African countries. This, to the extent that the World Bank would advance this argument, and to the extent that this argument is correct, would highlight the challenge of arranging bilateral financing rather than international institutions, right? And how this can lead to tensions between nations rather than an international institution mediating and providing facilities to stabilize national economies. Let us then begin with a brief overview of the evolution and history of international monetary relations. Historically, gold has been used as the reference point for currencies. The system of tying currency values to gold functioned quite well until the mid-20th century. The gold standard system in the early 1900s pegged the value of gold at $35 US dollars per ounce. And it's important when we deal with international trade to realize that there are tons of currencies out there that are named the dollar. That is, for instance, the US dollar, the Canadian dollar, the Zimbabwean dollar, the New Zealand dollar, the Australian dollars, and a number of other dollars. So for the purposes of international literature and discussion, the US dollar is abbreviated USD. That is US dollar. Up until since the early 1900s, the gold standard was pegged to the value of $35 per ounce of gold, which was the reference point that other nations used in fixing the value of their currencies. It is important to note that this price was not a commodity price. Indeed, private investors could not purchase gold at this price point. Governments had exclusive rights over private individuals to buy gold at this below market price, thus reducing the volatility of currency values. In 1944, the US government pursued an expansionary monetary policy in a bid to financially support World War II efforts. Please note that expansionary monetary policy involves a reduction in taxes and an increase in government spending. So understand this again. So when governments want to make more capital, want to increase the liquidity of markets and make more capital available in the economy, it's called an expansionary monetary policy. And it involves a reduction in taxes. So when government reduces your taxes, the citizens have more discretionary income, and an increase in government spending. So there is subsidy in terms of governments providing financial support to lower income families, all things being equal, and or financing big projects that create employment and also multiplies the money supply in the economy. Both measures are meant to stimulate the economy and increase the level of activity within the economy. However, this policy caused inflation to rise and resulted in the US dollar losing value fairly quickly. Other nations quickly began stockpiling gold to prevent fluctuations in their own currencies. So let me quickly clarify this point. So when the government pursues an expansionary economic policy, as I just explained, where there is oversupply of money, relative oversupply of money in the system, one of the things that could happen, of course, is that you would have too much money chasing too few goods. And as any rational, and we've discussed rationality, right, in this class previously, actually on several occasions. When you have two flip-flops, let's say you have 10 flip-flops to sell, and you typically sell your flip-flops at $10, 10 flip-flops, $10 each. Except you have 100 people looking to buy these flip-flops, and 90 of them are concerned that this flip-flop is going to sell out quick and they will not have any flip-flops available for sale. you can see how you will quickly deduce that you can afford to charge 5, 6, 10 times the price of flip-flops. And yet you would have at least 10 people willing to pay that price, thereby purchasing all your stock. This is one way, this is a simplified way, of course, how an expansionary monetary policy can have an unintended consequence of inflation. So other nations quickly began stockpiling gold to prevent fluctuations in their own currencies. Eventually, the practice became quite unsustainable due to placing unrealistic demands on the inflation of the US dollar. In 1944, the gold standard was abolished and replaced with the pegged exchange rate. Now that we have established a foundational overview, let us then transition to this week's learning objective. Objective 1, as I'm sure you know, is to explain the term balance of payments and how this concept affects the ability of a country to participate in global trade. About the balance of payment, or BOP, also known as the balance of international payments, is the difference in total value between payments into and out of a country over a period of time. Put differently, the BOP is the method by which countries measure all of the international monetary transactions within a certain period. The BOP consists of 3 main accounts. First, the current account. 2, or second, the capital account. And third, the financial account. Note that the current account is meant to balance against the sum of financial and capital accounts, but rarely does. The balance of payment transactions consists of imports and exports of goods, services, and capital, as well as transfer payments, such as foreign aid and remittances. A country's balance of payment and its net international investment position together constitute its international accounts. Globalization in the 20th century, led by balance of payment liberalization in many emerging market economies, developing countries lifted restrictions on BOP accounts to take advantage of cash flows arriving from developed foreign nations, which in turn boosted their economies. So the second learning activity for the week, of course, is to describe the International Monetary Fund and how it facilitates world trade. The International Monetary Fund, founded in 1944, is a voluntary financial institution with a membership of 184 countries. It fosters among these countries cooperative monetary policies that stabilize the exchange rate of one national currency for another. It thereby encourages international trade. The IMF provides a mechanism in which each country can operate with the others to promote its domestic economic prosperity, and that of the entire membership. The IMF maintains an extensive database of statistics on members' economies and the world economy as a whole, which it shares with every member country. At the request of a member, it extends technical assistance in financial, fiscal, and economic matters. And this next point is crucial. If persuaded that a member country is behind in its payments to other countries, the IMF will implement reform policies. The IMF will lend money to tide that member over until the reform takes effect. Lastly, the purposes of the IMF are clearly expressed in its Article 1 of its constitution. The article agreement includes, first, to promote international monetary cooperation through a permanent institution which provides the machinery for consultation and collaboration on international monetary problems. Second, to facilitate the expansion and balanced growth of international trade and to contribute thereby to the promotion and maintenance of high levels of employment and real income and to the development of the productive resources of all members as primary objectives of economic policy. Third, to promote exchange stability, to maintain orderly exchange arrangements among members, and to avoid competitive exchange depreciation. Let me clarify that very quickly. Competitive exchange depreciation. So, if country A and B sell shoes to country C, it is indeed possible and on some level a rational conclusion for one of the countries to suspect that if they were to devalue their currency, it would make it cheaper and therefore more enticing for country C to purchase their widgets. Should one of these two, either country A or country B, come to this conclusion, you can see how it would quickly devalue its currency to make its goods cheaper and therefore much more competitive. The problem with this, though, is that we begin to hint a little bit about what we discussed last week about the prisoner's dilemma, where if the prisoners were to cooperate, they are likely to get an outcome that is more beneficial than if each were to act in their best interest. Especially as in this case, it is likely that this action will have an unintended consequence. For instance, if country A were to devalue its currency in an attempt to make its goods less expensive and therefore more competitive, it is quite likely that country B would follow suit and match that same logic by even further devaluing its currency to make its goods and services even much more competitive. This could quickly lead to a race to the bottom, where both countries devalue their currencies so much that they may well be unable to finance the purchase from the international market of the input products that they use in manufacturing the products that they seek to sell to country C. So you can see how, going by the prisoner's dilemma analogy that we covered extensively last week, that is more helpful if these countries were to cooperate, and one of the better forums for this cooperation in order to avoid competitive exchange depreciation will be the International Monetary Fund. So fourth value proposition of the IMF is to assist in the establishment of multilateral system of payments in respect of current transactions between members and in the elimination of foreign exchange restrictions which hamper the growth of world trade. Fifth, to give confidence to members by making the general resource of the fund temporarily available to them under adequate safeguards, thus providing them with opportunity to correct maladjustments in their balance of payments without resorting to measures destructive of national or international prosperity. Let me unpack that for a second, because this is where some of the tension comes in. And this is where the good old-fashioned conditionalities come in with respect to IMF facilities. So IMF facilities clearly are supposed to be temporary, and they're supposed to tide countries over till they get past the rough patch. But there is also the obvious logic that there are maladjustments in their balance of payments. In other words, the value of the goods and services the countries import exceeds the value of the goods and services that they're seeking to import to finance, to keep lubricate their economy and meet demand. So when your overhead is more than your income, there is a maladjustment. And you need to do a number of things. You need to cut down your overhead even as you try to improve your income. This is, at its most basic level, what conditionalities seeks to do. Now, in the real world, here is how those conditionalities can impact. Here are some of the ways those conditionalities can impact an economy. One way is that most countries that face these challenges, or many countries that face these challenges, have unsustainable economic subsidies. Either they're subsidizing gasoline, they're subsidizing healthcare, they're subsidizing education. The problem, though, it's sort of like when we as individuals are broke and we can't afford to pay our rent, but we're buying ice cream and going to the movies. Those are fun things, by the way, but those are probably not things you want to engage in at the expense of paying your rent and having a roof over your head. So one of the prudent things to do would be to cut your expense. So you now go into an economy, and the net result in real life is that the IMF will go into a country that is facing economic challenges. There is perhaps high unemployment and economic contraction. And then the IMF would, by necessity, ask the governments to reduce the size of government, which almost always means letting some people go. The IMF will ask the government to reduce the levels of subsidy, if not eliminate the subsidies and other inefficiencies in their economy. Again, you could see how, at least in the short run, this can create economic hardships. Yet, these are necessary, and these were not caused by the IMF. These were caused by inefficiencies in the economy. And the remedy to fix these inefficiencies will be to eliminate the inefficiencies, naturally. But because they usually happen because governments lack the political will to enact these policies, even when they know that these policies are necessary and unavoidable, the IMF becomes an easy boogeyman to blame for the hardship. But this is just to put it all in context, to say that, yes, conditionalities can impose hardships. But those hardships are only necessary because those governments and countries have an inefficient system, and that the only way they will have any hope of balancing their budget will be to reduce their overhead and increase their productive capacity, and therefore the goods and services that they're able to trade in the international market. The sixth is, in accordance with the above, to shorten the duration and lessen the degree of disequilibrium in the international balances of payments of members, right? The disequilibrium is, of course, balancing between what your accounts receivables, what the economy takes in versus what the economy needs to import. So the third learning activity for the week, of course, is to explain how exchange rates are used to manage world trade by individual nations. So it is helpful to understand what exchange rates really mean and understand the various kinds of exchange rates. So it is helpful to begin by differentiating between floating, pegged, and fixed exchange rates. The advantage of floating exchange rate currency is that it can be traded without any restrictions, unlike currencies with fixed exchange rates. Hence, governments and banks do not need to resort to continuous management process. Floating exchange rates enhance the efficiency of the market, especially as a country's macroeconomic fundamentals affect the floating exchange rate in global markets, influence the flow of portfolios between countries. In a floating exchange rate, central banks are not required to keep large foreign currencies. foreign currency reserve amounts for defending the exchange rate. Hence, the reserves can be utilized for promoting economic growth by importing capital goods. A good example of a country that institutes a floating exchange rate is the United States, Germany, United Kingdom, and many other advanced economies, with the exception of China. Disadvantage of floating exchange rates are that they are prone to fluctuations and are highly volatile by nature. A currency value against another currency may deteriorate only in one trading day. This is because the market gets to determine how much confidence it has in that currency, and therefore the demand for that currency. And the value of a currency is based on the demand and then the supply. If the demand is low, the value drops. So this, in an economy that is not as fundamentally sound as the advanced industrialized economies, a floating economy can quickly deteriorate into a volatile currency. A floating currency, can quickly deteriorate into a volatile currency. The lack of control over floating exchange rates can limit economic growth or recovery. As I said, the central bank does not control the value of the currency. The government does not in any way control the value of the currency. The markets, the laws of demand and supply, and the confidence the market has in that currency determines the value of that currency. The negative currency exchange rate movements may lead to serious issues. For example, if the dollar rises against the euro, it may be more difficult to export to the Eurozone from the US. And that's all things being equal. Because if the value of the dollar rises relative to the euro, it would mean that folks in the Eurozone will need more euros than they did prior to that increase in value to purchase the same amount of goods and services from the United States. If a country is suffering from economic issues such as unemployment or high inflation, floating exchange rates may intensify the existing problems. For example, depreciation of a country's currency already suffering from high inflation will cause inflation to increase further due to an increase in demand for goods. Moreover, expensive imports may worsen the country's account. Again, realize that if I say that the US dollar has appreciated in value relative to the euro, I am also conversely saying that the euro has lost value relative to the US dollar. Again, it would mean that if you live in the Eurozone, you would require more euros to purchase the same amount or size of the same value of goods and services than you did prior to the appreciation of the US dollar. The next is a fixed exchange rate, also known as the gold standard. It quantifies the value of currencies by using a stable reference point. Historically, gold has been used as a reference point. This is because it is a valuable commodity worldwide, and its value is less susceptible to fluctuations in interest rates. Then comes the more widely used mechanism, especially among developing or emerging economies, which is a pegged exchange rate system. It incorporates aspects of floating and fixed exchange rate systems. Smaller economies that are particularly susceptible to currency fluctuations will peg their currency to a single major currency or a basket of currencies. These currencies are chosen based on which country the smaller economy experiences a lot of trade activity with, or which country the nation's debt is denominated in. Think about this. If most people, if say Caribbean countries trade mostly with the United States, to create stability in the transactions between the Caribbean countries, and I say this generally, of course, because there are a number of currencies there, and the United States, it will make sense to have a peg, right? So that you know, if I have X $3 or 3X of this currency, it will get me $1. And there is confidence that you know what that translates to. And that's on a private sector transactional level. But it gets even more necessary when you think about debt. So if you wanted to build a laundromat, let's just say hypothetically, you wanted to build a laundromat in Jamaica, and you wanted to finance the purchase of laundry machines and dryers from the United States, and you borrow money, realize that you're going to generate income in Jamaican currency when you build this laundry mat. You're not going to generate income in US dollars, but you will be paying off your loan in US dollars because that's where the currency and the place in which you finance the purchase of the laundry equipment. So to be able to reasonably forecast if this business will be profitable and if you can generate enough profits from this business in Jamaican currency to pay off a debt in US dollars. It may be helpful to have some stability in understanding that while each machine cost me $1, and I'm saying this for simplicity, once I charge more than $3.5, 3.5 of Jamaican currency, I would have more than $1 for each transaction. That's just the clarity that a peg creates for borrowers in emerging markets. So that's why the currencies that emerging markets or smaller economies choose are based on which the smaller country experiences a lot of trade activity with, or which currency the nation's debt is denominated in. Another system is what the Chinese do, which is based the yuan, the Chinese currency, on a basket of currencies. But I think the dollar has the highest weight in that basket, those basket of currencies. Some argue that with this system, the Chinese artificially keep the value of their currency low so their goods can be more competitive in the international market. That's a school of thought that is there. Of course, the Chinese disagree. I must add. Lastly, it is helpful to note that countries should have a macroeconomic growth strategy, a theory of growth. This may include a combination of A, an import-led economy, B, a domestic consumption-led economy, or C, an export-led economy. So these are the combination of three ways macroeconomically that countries can grow their economy, and countries have to have a strategy based on their comparative advantages, how they like to grow their economy and earn foreign exchange. So this concludes our formal lecture section. We will now transition into Q&A, but before we do, please note that next week's lecture will be on global trade relations. So this is, if it's okay with the class, I will now shut down the recording and we can transition into Q&A and other housekeeping matters.